Hello there. Welcome to the Open right here on BNN Bloomberg. Happy Tuesday. Let's get to the big stories we're bringing you from our newsroom. The United Arab Emirates says it has decided to exit OPEC and leave OPEC Plus as of May 1st, in line with its strategic and economic long-term plan. UAE says it will continue to act responsibly and gradually increase oil production in a measured manner. The Middle Eastern country says its decision to quit the oil group is based on its national interest. Shares in Celestic are dropping 15% in the pre-market. First quarter results at the maker of electronic components and assemblies came in with a smaller beat than in recent quarters. The Toronto-based company did raise its full-year forecast. However, analysts say expectations were even higher.
I don't think there's anything wrong with the company. In fact, they met in terms of their earnings and revenue. It was the guidance that perhaps was a little bit softer than what the street had thought or had hoped for. However, also look at where the stock has come over the last month. Up more than 50% over the last month. That's significant. So yes, we're down 14% today, but it's just a reset of expectations, and expectations that coming into it were probably a little too lofty.
The federal government is set to announce its fiscal update this evening. According to recent data, Canada ran a budget deficit of close to $26 billion between April and February, well short of the $78 billion deficit projected in the budget plan. The Prime Minister, Mr. Carney, said yesterday that the update will deliver encouraging news on the public finances. And it looks like we're going to get a slightly softer open for U.S. stocks. The Wall Street Journal ran a story saying that OpenAI is missing internal targets on growth for users of its AI models, and that may be worrying investors today. And let's have a look at the TSX, which is still shy of record highs. And there you have it, up 37% though, 36% in the past year. And let's check out oil as investors impatiently await some kind of resolution in the Persian Gulf. You can see prices climbing again, not far short of that psychological $100 mark for the most active U.S. contract. And let's see where gold is going this morning as we await central bank decisions this week, and gold slipping a little bit. And checking out the Canadian dollar. There you have it, the Canadian dollar still above 73 cents. It has bounced off the low of a few weeks ago. And finally, Bitcoin. Let's see where that's going. The biggest crypto, you can see it has been gradually bouncing off the bottom of the winter, but still way down from last fall. It's a huge week for corporate earnings, and efforts continue to reach a permanent or semi-permanent ceasefire in the Persian Gulf. Our guest points out that strong earnings across the broad markets could still push stocks to new high this year, and we could be in for a more diversified global rally. Let's get more from Sadiq Kadashia, Chief Investment Officer at BMO Global Asset Management. Sadiq, great to see you as ever.
Thanks for having me.
The big story seems to be, as you highlight, corporate earnings, certainly south of the border, holding in just fine.
Yeah, we've got some big earnings coming up this week, obviously on the tech side. But overall, we have seen pretty strong earnings across the board, with little kind of conversations about the fact that the inflation story or obviously the oil prices is significantly impacting earnings. And I think that's important because when we think about the broader earnings story, it comes down to, how are consumers spending? How are they going to react to what's going on? And so far, short-term noise is there, but not really a lot that's determining, a big impact on the earnings front. So we expect things to kind of continue to play out this way. Again, it's on the premise that, we don't see a long, drawn-out scenario here. But at the way things are progressing at the moment, it should have minimal impact on earnings, and that should be very positive, and that should support the valuations and where the markets are at today.
Every so often, though, the market seems to get cold feet about AI and the massive amount that's being spent.
Yeah, I mean, that's a great question. I mean, if you remember last year and early part of this year, there was a lot of concern on, is AI a bubble? Are we going to see, valuations get too extreme here? And, we did see, pressure on those names. But when we saw during the U.S.-Iran, conflict starting, we saw a lot of markets pull back, and AI stocks were one of those. And so the valuations came down quite a bit. And what we've seen since then is that people have jumped back into those names, and they have taken off the game. So the valuation part was partly solved by this U.S.-Iran situation. And then when you think about kind of the oil situation and maybe some inflation, the AI story really is not impacted by that tremendously, right? So therefore, that might be kind of a safe haven spot for the time being. But the question will be, like, once we start to see a resolution and oil start to move again, does that broadening out story continue to play out? Do people start moving away from AI stories again and back to the broader economy? And we'll see that, I think, gradual over time. But I still think that the earnings are going to be relatively strong here, and that should support continued movement in the tech sector in particular.
You're broadly overweight the U.S. equity market.
Yeah, we've remained overweight U.S. for quite a bit of time, but we have taken profits, last year, again, earlier this year as well. Again, as we're also broadening out our story, into emerging markets, for instance, as an example. But we still believe that U.S. is still a strong economy with strong companies. Again, we'll see by the earnings story that that's going to be relatively strong. And the U.S. consumer looks really, really good. And even though, we're seeing an inflated oil price, don't forget, right, that the U.S. is now a net exporter of oil. And so it's not as impactful their economy today as it may have been, 5 or 10 years ago. So again, all of this still, if you take that into consideration and you look at the global landscape, compared to international markets for sure, U.S. looks significantly stronger. So, we would tilt more to the U.S. and less to international markets, but we would still be tilting quite a bit to emerging markets.
What about bonds? Because I see that you're slightly underweight utilities and real estate, Sadiq. So are you slightly apprehensive that bond yields are going to go up and bond prices drop?
Yeah, well, I wouldn't say we think the bond yields are going higher. Just the fact that we have seen interest rates kind of get deferred out a little bit more. So coming into the year, we were expecting Fed rate cuts, and we still believe in that, but we think it's deferred out quite a bit now, and might even run into 2027. So with that scenario, that's not as bullish for bonds. On the utility side, we've seen that valuations go up a little bit there. And same on real estate, given the fact that we are going to see, a deferral of rate cuts, that also has an impact on the real estate market as well. So generally, where we're, tilting our dollars to on the sector side is technology and financials. And as you said earlier, underweight real estate, utilities, and even consumer staples. We think that's got a little expensive as well. So we really want to focus on growth areas, and those are the areas that we see a lot of growth. And again, on the inflation side, I don't think inflation will be a big problem, but it does cause people to wait and see now, the impact of oil. And that means that interest rate decisions have to get pushed out a little bit further out. And that is not necessarily positive for bonds.
You reckon Canadian stocks are a bit cheaper than their American counterparts, but you are neutral, Canada.
Yeah, for the last few years, we have been underweight Canada, and I think rightfully so, just from the economy perspective. Now, Canada's got a great tailwind here because of what's gone on with the energy side, and obviously the last few years on gold, and even the financial stocks have had a great run as well. When we just look at the underlying economy, we're still a little bit concerned there. Again, oil prices are going to give a little bit of a boost from the standpoint of earnings broadly on the oil sector, and of course to Canada's economy. But there will be headwinds on the consumer side as a result of that. So Carney's excise tax removal is a good positive to help out on the consumer side. But there's still the USMCA deal that who knows what that looks like, to be honest with you, in a year from now. But we will say that will have a very big impact on how Canada's economy moves forward, right? So if it's a positive situation, we could see Canada really bounce back strongly. If it's not as strong, that could see an impact on the Canadian dollar. It could have an impact on growth and employment. So all these things are still at a pause at the moment, which holds back us from being exceptionally bullish on Canada because no one's really investing a lot in Canada at the moment until the USMCA deal gets done. And then again, I think, even though what Carney's been doing is great out there talking about stuff, at the timing of a USMCA negotiation, it's going to make it a little bit trickier as well, too. So that puts a little bit of a cloud over Canada from that side of it as well. But valuations look really good. Mm-hmm. And if we were to head another leg down lower, I think Canada outperforms because of its energy and obviously exposure to commodities, which I think will be a good defensive hedge.
Sadiq, thank you very much indeed.
Thank you for having me.
Sadiq Kadash, as Chief Investment Officer at BMO Asset Management. Coming up, can the visit of the King to the United States help calm tensions with Canada as we get set for CUSMA renegotiations? King Charles and Queen Camilla landed in Washington yesterday for a 3-day visit to the U.S., marking 250 years of American independence. Now, this comes at a turbulent time. Transatlantic ties are under strain. And, of course, the British Prime Minister, Keir Starmer, has refused to join the U.S. attacks on Iran. Let's get more from CTV's Scott Hurst. So they're in the U.S. We do hear that President Trump is close to the King, but this is a turbulent time with the souring of British-U.S. relations. Give us the latest, please.
Edgar, good morning. They arrived in the U.S. yesterday and are set for a busy day ahead with a state dinner and an address to a joint session of Congress, where the King is looking to emphasize the special relationship between the two allies. It is a high-stakes visit and likely one of the most consequential of the King's reign so far. You mentioned the tension between the two countries, particularly as the U.S. president has often vented at the frustration at the British Prime Minister, according to the U.S. president, over the lack of support to the U.S. for the war in Iran. And despite the tension with the U.K. Prime Minister, it has been a warm welcome for King Charles and Queen Camilla so far. So as I mentioned, the joint meeting of Congress, that is taking place today, where the King is set to emphasize the shared history in that joint address. Overall, it is a 4-day trip to America, including the state dinner as well later in the week, visits to New York and Virginia. The last time a British royal addressed the U.S. Congress, 1991, when Queen Elizabeth delivered an address to lawmakers in the nation's capital.
Now, is there any possibility that the King's visit will calm tensions between Canada and the U.S., particularly on trade? We're talking about the monarch's voice, obviously, here in support of Canadians.
And the monarch's voice might go a long way with the U.S. president. Of course, tension between the U.S. and the U.K. will be at the forefront, but King Charles is, of course, our king as well and has strong statements, even just last year when he was invited to address the speech from the throne here in Ottawa. He had strong statements about Canada and its sovereignty. One line in particular stands out, saying the true north is indeed strong and free. And so we've seen the U.S. president direct his frustration toward Canada, calling us the 51st state, of course, through our sectoral tariffs that are still having a significant impact on many Canadian businesses and our economy. And with the CUSMA reviews getting closer, administration officials have often said Canada has taken advantage of the U.S., but we all know Trump's affinity and affection for royalty and all the pageantry that comes with it. So if there's one head of state who can get through to the U.S. president on a more personal level, it is very likely to be the King and his strong support for not just the U.K., but for Canada as well.
Scott, thank you very much indeed. Scott Hurst, our colleague at CTV News. Up next, John Ruffalo, founder and managing partner at Mavericks Private Equity, has been calling for Canada to establish a sovereign wealth fund for ages. And he says this new fund planned by Ottawa could help the economy if executed properly. We'll hear from him next. There still are questions over how exactly the Prime Minister's sovereign wealth fund for Canada is going to work. We were joined by John Ruffalo, founder and managing partner at Mavericks Private Equity. He thinks the fund could help the economy if executed properly. Let's have a listen.
It is the size of the Alberta Heritage Fund or thereabouts, but it pales into comparison of the Norwegian fund, which is topping at around $2 trillion.
Yeah, that's not even close to that. You've been calling for this for months and probably longer, yes. I imagine. Will this make a difference at 20? It's a start, but will it make a difference? Will we see it used properly?
Yeah, now there's still lots of details to come out. You know, what I hope is that this is just the seeding of it. But there is an opportunity to really scale this up and really have a source of permanent capital, not only for Canadian investments, but to support the wealth of Canada by even investing abroad as well. So I hope this is just really the tip of the iceberg.
Do you think there's interest in wanting to invest in this?
Well, I certainly there's the opportunities. Now, the one thing that remains a little unclear to me is, you know, in the press release, they made reference to some infrastructure type projects, but there is a dearth of capital available for venture and growth opportunities, particularly in the innovation space. You know, in the age of AI, we're seeing all these countries around the world invest heavily. There's an opportunity to invest in Canadian-based opportunities here as well. So I want to understand more on the breadth of the opportunity, and I think more capital is welcome, and it might attract private sources of capital as well.
And how have we done at things like this? Are we any good at it?
Well, so this is the key here. So governance is absolutely critical. What no one wants to see is a government slush fund achieving, you know, really political points and money wasted. We need proper professional governance models like the CPBIB, the most recent Canada Growth Fund, CDPQ. There is a number of examples, but this is critical. The details haven't been released on that, but I'd be looking towards that to make sure we get it right.
And is there a legitimate worry that this could end up as a bit of a pork barrel?
Well, it is if it's just a crown corporation being dictated by whoever government is in power, then yes, that is the big risk. So, I know this government here was very concerned around the governance model. And so I am quite curious to see where they might be landing.
And what would you like to see for a governance model?
I'd like to see this independently managed with no political influence. And their job is to not only invest in Canadian sovereign opportunities, but also achieve a rate of return so that this continues to grow and is completely sustainable for all Canadians.
And what's a good rate of return to you?
So if you compare this as a proxy to the long-term pension fund rate using 20 plus years, every single major pension fund has generated a return of at least 7% compounded. And if the source of the capital is our debt or our bonds at 3.5%, then you're generating really a spread on our borrowing rate versus what you're able to generate. So that gives me optimism that we could replicate the Canadian pension fund success here as well.
And should we be modeling on another sovereign wealth fund that, like I know they have them in the Middle East? You mentioned Norway. Is there one that might be comparable to what we are hoping to do?
Well, I mean, there's a variety of them. There, as you indicated, the Middle East. There's a couple in Asia, but Norway is the example that most people use. At the time that it was created, it was approximately the same size as the Alberta Heritage Fund, but it had independent governance. And look at the difference. And the one thing that Norway had, which I think is interesting, there's actually two funds inside of it. One that exclusively invests in domestic sovereign opportunities in Norway, and a much larger fund that invests around the world in order to generate a consistent rate of return so that you have the money sustainably to make the domestic investments.
And is that working?
It's working to the tune of $2 trillion.
They have they had a tremendous amount of oil too, right?
Yes. And now this is the lost opportunity for Canada, is that, we had all these oil revenues, and we didn't have a big deficit. And if we did this properly, we would have started this 40 years ago. But the second best time to start this is right now.
And how is the Alberta one doing?
Well, not very good. It started earlier than Norway. It actually was growing larger. And then I cannot recall exactly. I want to say it was during the Ralph Klein administration that they took money from the fund to keep taxes lower and to fund the deficit. And others were pushing it for a sales tax, and they made a political decision. And today, I think the size is around $28 billion, and it could have been $2 billion or, thereabouts.
2 trillion.
If it was untouched.
And now, do you think politicians will have the stomach to step back and not have control over money?
Well, we did it with CPBIB, right? This is taxpayer money to fund the future CPB payments. And there's an independent board, independent management. It works extremely well. It works closely with the Department of Finance, but it is independently managed. So we have those models and a proven success story in Canada. Why not this as well?
We got the opening bells next. There you have it. Trading is kicking off on Wall Street and on Bay Street. At the NASDAQ, Operation Hope is ringing the opening bell. At the NYC, it's Joby Aviation doing the honors. And at the TSX, it's IG Wealth Management opening the market. It's time for the first 50. And let's check in on the equity markets. That Wall Street Journal about OpenAI missing internal growth targets has put something of a shadow over tech stocks. You can see the NASDAQ down around 1.2%. Of course, the big worry with OpenAI is its massive planned spending and borrowing. Now, of course, the IPO will attract enormous interest, but the problem, of course, is will the spending be justified in any kind of a reasonable time frame? So there you have it, a slightly soft open for stocks today. Some shares of interest here. Celestica is a tech darling, but we've seen it come under severe pressure today. RBC have an outperform, saying that the company delivered another solid quarter. However, the beat was smaller than the major surpluses that investors have got used to. There is an increase, though, in the forecast for fiscal 2026. And RBC says the comments do imply that revenue in fiscal 27, I should have said fiscal 27, will be above consensus. However, this drop in the stock, RBC says, may reflect even higher investor expectations because the stock had jumped about 51% in just 1 month. Barrick pushing ahead with plans to list its North American operations after an IPO. The primary listing will be New York. The primary listing will be New York, with Toronto as a secondary venue. And the company says it's on track to complete that spin-off of the US and I think Dominican Republic operations by the end of the year, separating them out from the higher risk operations in Africa. And TELUS got an upgrade at TD Cowen to buy. The analyst over there, Vince Valentini, citing what he says is better pricing discipline. But of course, that's been hanging over those telecom stocks, the worry that prices are going to stay low. Let's check out some stocks of interest south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, thanks very much for joining us. Corning, the specialty glass maker, seen as a play on tech, obviously. Investors not thrilled right now?
Investors not thrilled right now. This is the worst performing stock in the S&P 500. As you said, this is a kind of a play on tech. This is a fiber optic cable maker. And obviously, data centers and the tech build out is going to require a large number of fiber optic cables to make all of those bits and bytes move through the systems. This is a stock that has really had a sharp run out as a kind of a beneficiary of the AI build out. And it had only a slight miss in this quarterly guidance. So the company is looking at second quarter earnings per share of between 73 and 77 cents. The midpoint of that is just below the expectation of 76 cents. So this is a very big drop for a guidance miss of only a couple cents. But you do see on that stock chart there just how dramatically these shares have run up in this kind of AI build out. And actually, if you scroll back even further, this is a stock chart that a number of strategists on Wall Street have been watching closely, because the last time the shares were this high was back in 2000. Obviously, with the build out of the .com era, required a lot of fiber optic cable as well. And if you look at the stock chart over that period back all the way to 2000 and maybe 1999, you'll see two very distinct peaks back then and right now. So you do have kind of a period here where investors are very closely watching all of these companies that have been beneficiaries, secondary beneficiaries of the AI build out, and Corning is definitely one of them. Taking a big hit, as I mentioned, worst performing stock in the S&P 500 so far today.
But the chart's gone up exponentially, as we can see. Yeah, it's interesting. A bit like Celestica after its big run up, correcting a bit today. And just give us a little bit more on OpenAI here and this miss on its sales targets.
Yeah, so one of the stocks to watch today in this is Oracle. Oracle is one of the worst performing stocks, not down as much as Corning, but down about 7% in the pre-market session. So worth watching over the course of the trading day here, because as you mentioned, this OpenAI fallout. There are a handful of other companies as well, but Oracle is one worth watching. So OpenAI, according to a Wall Street Journal report, missed some of its internal forecasts and targets that it wanted to hit. And as a result, there are some questions about whether or not it's going to spend the amount of money that it had planned to spend on that data center build out. Now, some of the companies kind of downstream from that had been investing in data centers are taking a hit as a result. And Oracle is the one to watch today because it is seeing the sharpest move down among that group. Bloomberg Intelligence out this morning with a note saying that this is, quote, the most exposed. Oracle is the most exposed in the group and looks vulnerable after this report, which I do have to mention, is still a report. We have not heard confirmation yet from OpenAI, but it will be closely watched as we go forward here.
Thanks very much, Jeff. Bloomberg's Jeff Morgan. Coming up, earnings, the Fed, and the future of tech. Is this the most important week of the year for markets? That's ahead. Something like 42% of the S&P 500 is due to report this week. And of course, tomorrow's the day. We'll hear from Amazon, Google, Microsoft and Meta, and then Apple on Thursday. What should we look out for? Let's unpack with Mark Sebastian, founder of Option Pit and Chief Investment Officer at Carmen Line Capital. Mark, great to see you as ever.
Good morning.
You think this is possibly the most pivotal week of the year for investors?
Yeah, I believe so. You know, on Wednesday, we have 4 companies that represent 18% of the S&P 500 reporting, as you said, Amazon, Google, Meta, and Microsoft. They also represent about 33% of the NASDAQ 100. So just these 4 names kind of encapsulate a huge portion of both indexes, and those are the indexes that are most widely held by people. You get follow-up on Thursday with Apple. And what I'm really interested out of these earnings is how does the market look at spending? And Tesla gave us a little glimpse of this last week, right? Tesla, the earnings initially came out. They were good. They beat, blah, blah, blah. Stock is up about 4%. They get on their earnings call, and they talk about the amount of spending they're going to be doing. And this time last year, heavy spending on things like AI, it was considered an investment, something that would grow the company. And we saw companies make a really nice move higher on spending, something that, you know, your years in the business, my years in the business was kind of the opposite of the way normally a stock would behave. Now we've kind of reset back to the traditional way of looking at spend, and Tesla announces their big spend and drops $30 and ends down 3% on that day rather than up. What does the market view the spending coming out of Amazon, Google, Meta, and Microsoft? How does that really, you know, how do those stocks react to what they're spending on? If the market says to an Amazon or a Microsoft, the spend you're doing is going to make you money, we may see those names rally on that. But if that entire group is lopped into they're just spending money and it's bad for their long-term earnings, it could be a really rough day Thursday morning when these names start trading in the regular market.
So you think investors want concrete projections here of how this spending is going to translate into profits?
Yeah, spending needs to translate is what it comes down to, like you just said. And so the earnings themselves are not going to be, you know, I'm not sure those matter that much. Guidance matters. If you're listening to one thing on these conference calls, one thing, listen to the spend and watch the stock move once that's announced. That's going to give you a clear direction for how those stocks are going to behave on the following day and likely the following several days.
We get the Fed interest rate announcement tomorrow. What are you looking at for there, Mark?
I mean, I can't imagine that they're going to be moving rates. This is Powell's last meeting before Warsh starts taking over. But pay attention to kind of how the different Fed governors vote, how they speak following this meeting, and those Fed minutes, and when those come out. Because Warsh, obviously, he's not going to go crazy, but he's not in there because Donald Trump doesn't want rates lower. He clearly wants to move the Fed funds rate lower. The question is, can he? And that's where what are the other Fed governors saying? What do the dot plots look like? And you know, obviously inflation as a whole, but the outlook from the governors that are not leaving, to me, I think is the more important thing to pay attention to than what Jerome Powell actually has to say during his news conference.
Leave us with a final thought. The Persian Gulf, has that really been put on the back burner now? Investors are just letting that situation bubble?
I mean, clearly. I wouldn't have thought it would happen this fast, but you have the S&P sitting at an all-time high, the Q sitting at an all-time high. We've seen a kind of a reflation of technology companies moving higher. Obviously, Corning not having a great day, but technology's made a big move higher. Energy has held even in as kind of that's become less interesting. We've moved on to earnings. We've moved on to what's going to happen with interest rates. one caveat: if there is a true ceasefire and there is a deal signed, I would wonder whether that does become a little bit of a sell the news moment, and we get a little bit of money coming off the table. But it's hard to argue that we haven't moved on when the S&P is sitting at 7150, and when this all started, we were 6,900 and change.
We'd better jump. Mark, you've given us some things to look out for this week. Really appreciate it. Mark Sebastian, founder of Option Pit and Chief Investment Officer at Carmen Line Capital. After the break, we're going to take a look at what the Carney government's fiscal update may signal later today. What are we going to look out for when we hear from the federal government on its own books? That's ahead. The federal Liberals have been touting their efforts to make life more affordable for Canadians as they gear up to today's spring economic update. Let's get more from CTV's Annie Bergeron-Oliver. Annie, thanks for giving us the time. Just remind us, what are we expecting to hear from Ottawa today?
Hi, Andy. Well, the Prime Minister says that the Canadian government and his government are good fiscal managers. And so he's saying that there's going to be good news when it comes to Canada's fiscal position. So we know that the last budget, which was Carney's first budget, estimated the deficit to be about $78 billion for the last fiscal period. And some data from the Finance Department does show that the deficit is projected to be lower than that. The data showed that in the first 11 months of last fiscal, the deficit was on track to be $25 billion. Now, of course, that excluded any type of money that was spent in March, which everyone knows is a very busy period for both the federal government and departments as they try to get spending out the door before the end of the fiscal. So it is on track to be tens of billions of dollars lower, and that's what economists are predicting as well because of the high price of oil. Of course, if you're a consumer, the high price of gas is not great at the pumps, but higher oil and gas prices for the government does put a lot of money back into their pockets. So the big headline here is that the deficit is projected to be lower. The question is, how low is it going to go? Does the government project it to be reaching zero anytime over the next few years? And if not, then what is the projection for the deficit? Does it decline, and by how much over the next 3 to 5 year period, Andy?
Of course, the backdrop here is trying to move Canada away, or at least reduce the dependence on the U.S. How does this play into the economic update?
Well, that has really seemed to be central to most decisions that the Prime Minister and the federal government have made in the last year, is trying to make Canada's economy more resilient and less reliant on other partners in North America and specifically the United States. So in this document, you can expect to see a lot more talk about making Canada's economy more resilient, making Canada strong. And this is not new. This is something, again, that the Prime Minister has talked about a lot. It goes directly to his announcement yesterday. We talked about this Canada Strong Fund, the $25 billion endowment that the federal government is going to put into it to start it. This fund is going to be investing alongside the private sector to help get infrastructure projects in Canada built. This is going to be a really Canada-focused fund. And again, this comes back to making the economy stronger, getting these projects done, and helping Canadians in the short term and the long term. So we are expecting to see more details about that. And economists are also projecting that we're probably going to see some maybe more affordability measures, some more tax changes as well that could help Canadians that are struggling, in part because of the high cost of tariffs and the trade policy, but also because of the war in Iran. And then the final thing here is what a lot of people are wanting to see as more of a breakdown when it comes to defense spending. The government has said they want to spend 5% of GDP on defense, but that really hasn't been outlined in good fiscal terms. And so the government is potentially going to be outlining that in a bit more detail. That's at least what economists are hoping to see. The government has said that they don't want to spend about 70% of defense dollars in the United States anymore. And so one of the big things will be, do they show that in any capacity in today's document about spending defense in different countries other than the United States? And do they sort of chart a path to how we get to that big 5% number, Andy?
That's interesting. Yeah, of course, the Americans may not take kindly to that, those dollars being diverted away from them. Annie, thank you so much, as ever. Annie Bergeron, Oliver, our colleague at CTV News. Okay, we're getting a Bank of Canada interest rate announcement tomorrow. We're going to have a preview after the break. We get an interest rate announcement from the Bank of Canada tomorrow. Let's get more from Jason Dole, Head of North American Rate Strategy at RBC Capital Markets. Jason, thanks for giving us the time. Just remind us, what is the market betting on from the Bank of Canada tomorrow?
Well, for this meeting tomorrow, the market's priced for nothing. So there is no expectations for a rate change. As we go out further into the year, the market is looking for the bank to possibly raise rates in the second half.
Right. So we get this news at 9:45 Eastern Time tomorrow, and there's going to be 8 policy decisions. The bank schedules 8 each year. Later on in the year, do you or does the market anticipate any change in rate policy?
Well, our base case scenario is that the Bank of Canada is on hold for the duration of 2026, that they would start raising interest rates in 2027, but there is a risk that those hikes get brought forward into the second half of this year, and potentially that tightening cycle starts in the back half of this year. When you think about the other policy options, I think the chance of rate cuts are pretty low at this point, given how the economy has been evolving.
The oil-induced inflation, I know that's the $60 million question or $60 billion question. How long will this last, this jump in energy prices?
That is the very uncertain aspect of what's happening in the Middle East. We know that oil prices are pushing towards the highs that they had a few weeks ago. And what that means for Canada, it is a complicated outlook. People tend to think that high energy prices, high oil prices are good for the Canadian economy. But when you think about all the different factors, how it affects consumers, how it affects businesses, all the economic agents across the economy, the net impact could ultimately be close to neutral. Maybe it's a small positive, maybe it's a small negative. We know headline inflation has gone up. Gasoline prices at the pump are higher. That has induced a big jump in headline inflation. But whether that filters down through the supply chain into core prices, that is the unknown. And we think, at least with the current state of the economy, at least some excess capacity in the product and labor markets, that there probably won't be a big inflationary impulse to the broader economy.
So the Canadian economy ticking along right now, but the growth rate below 2%. Would the bank, in theory, like to see higher growth?
There are a lot of constraints at the moment. And, to be honest, growth around 1.5% is a good outcome for Canada. Last year, it was around 1.7. Q1, we're tracking around 1.5. This is a good outcome given the trade shocks and particularly what's been happening with population growth. Population growth was 0 last year. It's going to be 0 this year. 1 to 2% GDP, that's a good outcome.
That's interesting. So things could be a lot worse. The government talks a lot about affordability and does things like cut excise tax on fuel, for example, temporarily. Is there much the government can really do on that front, though?
The excise tax reductions are helpful. There can be other targeted measures to low, middle income households. They can definitely cushion the blow, but they can't fully solve it. And neither can monetary policy, to be honest.
What is your take on the Canadian dollar? Can you give us your base case for our currency?
Well, the currency is kind of pushing up to the highs that we've seen over the past year. Energy prices are definitely helping. Rate differentials, could be moving more in Canada's favor if the Bank of Canada did start raising interest rates. And, we had a risk-off scenario during the U.S.-Iran war. That's starting to be dialed back. and people are questioning, do they want to be long dollars? And it seems like the market is starting to gravitate to being short. So, over the medium term, maybe there's a little bit more upside for the currency, but I think we do also have to understand that over the past year, we have been bounded in some pretty tight ranges.
And just finally, it sounds like you're not anticipating a significant move in mortgage rates. I mean, longer-term mortgage rates.
Well, mortgage rates are going to be related to the market's expectations for the Bank of Canada. So if they are on hold this year, if the market's only pricing a modest hiking cycle, then maybe there's a little bit of upside, but not too much necessarily.
Thank you very much indeed. Really appreciate it. Jason Daw, head of North America Rate Strategy at RBC Capital Markets. Just ahead, Celestica beat on expectations, but the stock suffered. We'll be right back. Welcome to the second hour of The Open. Let's get to those big stories we're bringing you from our newsroom. The federal government is set to present its fiscal update this afternoon. According to recent data, Canada ran a budget deficit of close to $26 billion between April and February, well short of the $78 billion deficit that was projected in the annual budget plan. The Prime Minister says the update will deliver encouraging news on the country's public finances. And join us today on The Close for special live coverage of the Spring Economic Update. Beginning at 4 p.m. Eastern Time, we'll bring you real-time developments, expert analysis, and what it all means for the market and for Canadians. Shares in TFI International higher today. That's after the trucking and logistics company posted stronger than expected profit and sales in its latest quarter. And the profit forecast for the second quarter was higher than expected. TFI says the results were driven by strength in its truckload and logistic units, despite adverse weather. And here's a blow for the oil cartel, OPEC. The United Arab Emirates has decided to exit the group as of May 1st. It says this is in line with its strategic and economic long-term plan. UAE says it will continue to act responsibly and gradually increase oil production in a measured manner. The TSX down slightly in trading today as we await those crucial reports from tech giants, U.S. tech giants, tomorrow and Thursday. And you can see the TSX not quite back to its record highs. Celestica is helping to drag the market down. It is plunging 13% because the results haven't met the high hopes of investors and some analysts. Well, let's take a closer look now at Celestica. Just not delighting investors sufficiently, it seemed, even though they beat in the latest quarter. Let's get more from Diana Avigdor, VP and Portfolio Manager and Head of Trading at Barometer Capital Management. Diana, great to see you. Thanks for joining us.
Thanks, Andy. Treacherous markets today.
It's not a great day for AI sentiment. We heard OpenAI posting slower growth than hoped for. Just one of those days, or do you read a lot into this Celestica sell-off?
You know, it coincides with an unfortunate article in the Wall Street Journal that is talking about ChatGPT apparently missing their internal growth targets. So it would have put the whole AI and its suppliers into a little bit of a tailspin today, even if Celestica did not report. It is what we call on the trading desk an adult swim only day because there are so many moving parts. Celestica reported a great quarter. I would bring you back to the previous quarter where they also reported a great quarter and traded down. But what took them down last quarter was that they went from a 1% to 6% spending on CapEx. Now, the market these days doesn't trade on optimism alone. It wants to see results from this spending. And when I left the desk to come and talk to you, the stock was coming off its lows. I don't know whether it's still there. But on the call, the company said that they have much greater visibility out to 2027. So these guys are getting orders. And that is important in the context of this article that was out there just talking about the OpenAI not meeting targets. Because, a year ago when all the headlines were around about all this CapEx spending, it was a bit of a head scratcher because those are plans. And now the market wants to see the actuals. So we'll see what the Mag 7 report tomorrow. You mentioned it, and Apple to a lesser extent on Thursday. But I think that that's going to paint some of the picture.
Just to switch to an older industry, rails. CSX is a stock, the U.S. carriers on your radar. Is that a stock you've been buying lately, Diana?
Yeah, so, we spoke last time in our interviews, we were in about 30% cash. We're now down to about 10% cash. We've redeployed money into financials and rails, CSX being one of them. And that was a good investment because they printed a great quarter. They raised revenue and they raised margin guidance. And this came at a time when, there is elevated fuel input. So for them to be able to elevate guidance despite this headwind is a testament to their operational efficiency and well-managed company.
What about the Canadian rail, CP and CN? Do you like those as well?
Yeah, I think that the whole sector is benefiting from a resurgence in this mode of transport. And I think that you see, if you look at the charts of all of the rails, you will see that they're also doing very, very well.
What about the banks? Start off with the U.S. banks, if you would, Diana. Are they attractive right now? Do they look like decent value for the growth you're getting?
Yeah, so we are long Citigroup and Morgan Stanley and some of the Canadian banks as well. You have this tech sector that is very high growth, but lots of moving parts. And you have these banks that have printed in the U.S. an EPS beat of about 6%. They increased loan growth in aggregate about 2%. And one of the good things there is that it was some of the loan growth came from commercial, which bodes well for the local economy. Now, this is a good setup for the Canadian banks when they are going to report, and they report in a while, probably another month or so. We could see some higher reserves being built given softer Canadian economy. But valuation-wise, they're a little bit on the high side. But in this market, which is really navigated and shaped by volatility and inflation concerns and shifting investor sentiment, the dividend growth and the dividend stability and just generally cost control and discipline, we like the financials here and we continue to be invested there.
Leave us with a final thought, Diana. Is there something that investors are ignoring for the rest of the year? Is there some factor that you think people should be paying more attention to? Does anything leap to mind?
Andy, we speak about this many times. We continue to watch pricing, how stocks trade as an important factor. Could be the great story, and you can handle a little bit of downside for all investments. But we're not here to pick bottoms and tops. If the pricing doesn't work, if this market, and it's been very volatile, what's happened over the last month has been really quite incredible in the face of all the geopolitical news and all that stuff for markets to make new highs at this time. It's really quite incredible, and it's driven by earnings. But the pricing and how stocks act matters to us. So we will go back to 30% cash if the markets don't behave. And I think that that's a very important input.
Thank you very much, Diana. Always great hearing from you. Diana
Andy, I just want 10 more seconds. I want to say on air, thank you very much for everything that you've done for all your guests. I hear that the next couple of days are your last one. You are the OG of BNN, and you are incredible. Incredible interviewer. You've made all your guests very comfortable.
Thank you.
And I hope to see you around. Thank you for all of us.
Thanks, Diana. That's the very kind words. Diana Avigdor of Barometer Capital Management. I really appreciate it. Okay, plenty more against the backdrop of these looming CUSMA trade renegotiations. Quebec's economy minister is meeting with U.S. leaders. We're going to have more after the break. Quebec's new premier, Christine Fréchette, formerly economy minister for the province, is holding talks with U.S. leaders after a Quebec firm said it's shutting down, citing tariffs. And this comes as nationally CUSMA negotiations draw closer, revising that North American trade agreement. CTV's Geneviève Beauchemin has more in this report.
Quebec's new premier, Christine Fréchette, arrived in Washington just 2 weeks after landing the province's top job. Fréchette said she wanted to make her first official visit to Washington quickly to defend the province's interests as CUSMA negotiations loom.
And it was one of my priorities to come to Washington.
Fréchette met business leaders as well as Democrats and Republicans, but a surprising late addition to her agenda drew attention, a face-to-face with top White House negotiator Jameson Greer. This as the U.S. has become increasingly aggressive in its demands towards Canada.
Talking about the aluminum, talking about also the softwood lumber, talking about the energy we provide to New York State, among other things. And we discussed also the tariffs that are being applied to all these products, except energy, and the impact that they have, these tariffs, on American citizens.
And during Fréchette's trip, a Quebec City area furniture maker, South Shore Furniture, a company that began in 1940 as a wooden toy factory, announced it was shutting down. It said in a statement, "This decision is the most difficult taken in our family's history. It's the result of an unprecedented crisis in the Canadian furniture industry. In just a few months, our sales have plummeted by 77%. But Fréchette said there was another issue that drew reaction during her meetings. American alcohol pulled off Canadian shelves. But she says that won't change in her province until there are gains for Quebec. Fréchette also said both Democratic and Republican lawmakers were cordial and appeared to be looking for solutions. Geneviève Beauchemin, CTV News, Montreal.
Markets still jittery over the blockage or near total blockage of the Strait of Hormuz. What about some ETFs that could help you navigate these troubled waters? We'll look into that after the break. So we've still got this oil shock hanging over the markets. WTI trading close to $100 today. Are ETFs possibly a way to help navigate these waters? That's the theme of our ETF report today. We're going to look at 3 vehicles concentrating on clean energy, infrastructure, and quality companies. We're joined by Naket Ulal, Senior VP and the head of ETF Research and Analytics at CFRA. Thanks very much indeed for joining us.
Good to be here, Andrew. Thank you.
There's a lot of talk about hydrocarbons, but still we're seeing massive growth in zero emission or low carbon energy around the world. So one ETF that's on your radar is ICLN, iShares Global Clean Energy ETF. What do people get? All of these trade in the States. What do people get if they buy this one?
Well, really, it's a mix of industrials, utilities, and technology. We think it's unique because it cuts across sectors. Really, Andrew, if you look over the last 15 months, the defining macro trend has been countries and economic regions using natural resources as leverage, whether it's in conflicts, whether it's in trade negotiations. And we think a long-term secular response is going to be countries moving more towards self-reliance, whether it's in infrastructure, energy, and the related technologies. So we think an ETF like ICLN is a good opportunity for investors to invest in that secular theme in response to some of these crises.
Let's maybe have another look at the chart, because it certainly has done well over the past year. What do you think, what particular sectors in clean energy have been strong?
Well, we think clean energy across the board. Firstly, in terms of performance, you're right. It's up about 75% in the trailing 1 year, 22% this year relative to about 5% in the S&P 500. If you look at some of the big holdings, you've got big kind of utilities. You've got utilities and companies in China like China Yangtze, which is a big hydroelectric company. You've got utilities in regions like Spain and Portugal, which are going to face some of the impacts of what's happening in Iran. So it's really a mix of big utilities that have invested in renewables, companies like First Solar, which have technology related to solar. And so we think it's a nice mix of utilities, industrials, and technology stocks in this broader theme.
And let's have a look at your next idea, iShares Global Infrastructure ETF, IGF. Again, it trades in the States, and it's done pretty well in the past year as well. What kind of stocks does it hold?
It has done well. It's up over 25% this year, not as much as ICLN. But again, we think this is a secular theme that ties into the same narrative, which is really it invests in stocks that are really the critical backbone of most countries' infrastructure. This could be MLPs, kind of pipeline companies. It could be LNG operators. It could be big utilities. So again, a mix of industrials. And this one has more energy compared to ICLN. ICLN has more technology. This one is a mix of industrials, utilities, and energy.
Right. I see actually Enbridge is one of the bigger holdings in there, William. So there's a fair amount of pipeline stuff, but also there's at least one airport stock, actually two, Auckland Airport as well.
Right. Yes. Yeah. Actually, it's got also another big operator of airports out of Spain. So yes, it is a nice mix of infrastructure, industrials, and utilities.
And then your final idea here is the Fidelity U.S. Quality Factor Index, again traded in the States, FQAL. What kind of stocks do you end up with here?
This one, I say, is more of a core holding. It's actually kind of similar to what you would get with a core U.S. equity ETF if you invested in the S&P 500 or Russell 1000. But what they do is they put in more of a quality factor tilt. So they screen on things like profitability, balance sheet strength, cash flow, stability, and generation. So you can think of it as a core S&P 500 holding, but with a quality tilt. So most of the holdings are similar to what you'd get in the S&P 500 or Russell 1000, but more narrower and more concentrated in higher quality stocks.
Yeah, I'm looking at the top holdings as of March 31st. NVIDIA, Apple, Alphabet, Microsoft. So a lot of duplication there to a regular, say, S&P index fund, it looks like.
I think that's a fair point. There is. So I would say that's why I think of it more as a core holding as an alternative to a core S&P 500 or Russell 1000 stock, but with a tilt. I mean, if you look at the Mag 7, for example, this only has 5 of the Mag 7. So there are differences in holdings with the traditional equity holding, but there are, as you mentioned, significant overlaps.
Just finally, you spend a good bit of time looking at ETFs. What trends are you seeing? Are you noticing particular products are really getting a following among retail investors right now?
Well, I mean, firstly, the ETF space globally continues to grow, taking a lot of flows. We have seen the broader trend that investors have stayed patient and have stayed invested despite some of the conflicts, which I think has been very unique in the ETF space. And we've also seen increasing adoption of derivative-based ETFs, particularly for more defensive holdings like, defined outcome, covered call to generate income. So I would say investors are starting to embrace a broader universe of ETFs now available to them, which is now, like, for example, in the US, over 5,000.
We'd better jump. Aniket, thank you very much for joining us.
Thank you.
Aniket Ulal, Senior VP and Head of ETF Research and Analytics at CFRA. We've got lots more on the open. We'll be right back. We're watching shares in Barrick Mining today. It's generally a weak day for the gold stocks. The giant Canadian gold producer plans to complete the IPO of its North American division by the end of this year. The spin-off is expected to have its primary listing in New York and a secondary listing in Toronto. The miner also appointed 7 executives dedicated exclusively to North American Barrick. The division will include stakes in projects in the US and the Dominican Republic. GM has raised its profit outlook for the full year by $500 million. The automaker says its pickups and sport utility vehicles continue to sell, even as gasoline prices soar due to the Iran war. In fact, U.S. gasoline prices have just hit their highest in 4 years. GM beat profit estimates in the first quarter as demand for those pickups and SUVs stayed resilient. GM also faces lower tariff exposure than is expected a year ago. Shares in TFI International jumping almost 7% today. That's after the trucking and logistics company posted stronger than expected sales and profit in its latest quarter. The profit forecast for Q2 came in higher than expected. TFI says results were driven by higher profitability for both its truckload and logistics units, despite adverse weather. And here is a look at the TSX in early trading, down slightly. We are seeing some prominent stocks, though, hitting record highs. Great West Life, GWO, that stock's been going vertical lately and hitting a new record high. And also CIBC, CM in trading today, hitting a record high. So some of those, the TSX still off its all-time highs, but some of those Canadian blue chips attracting lots of buying. Sorry, I want to correct myself. We hit an intraday record for CIBC. The closing record was yesterday. So intraday record today for CIBC. And let's have a quick look at the US markets. We do have some jitters among tech investors that the growth in AI may not be as rapid and profitable as the optimists hope. And let's check out some of today's notable analyst calls. The first is from Scotia's John Samparo, raising the firm's price target on restaurant brands to $81 US from $71, but sticking with a sector perform rating on the shares. Apparently, Scotia is somewhat cautious due to the company's aggressive unit growth targets amid pressure on consumers. John Samparo, the analyst, saying further upside will need to be demonstrated if to avoid disappointment here. So sticking with the hold, but raising the target. And Citi analyst Tyler Radke is cutting the price target on Shopify to $163 US from $172, but keeping a buy rating on the shares as part of a pre-1 preview. The firm believes Shopify continues to benefit from agentic commerce modernization. That's the use of AIs to perform multiple tasks. And Stifel Canada is hiking its price target on Aritzia, and that's going up to $158 Canadian. Stifel expects a strong quarter from Aritzia when it reports its fiscal fourth quarter earnings on May 7th. Martin Landry hiking the price target, as I say, by $8 to $158, and hiking comparable sales growth expectations to 21% year over year. Yesterday on Market Call, we were joined by Richard Fogler, Chief Investment Officer at King West & Company. His focus, North American equities, and his top picks were TMX Group, Citigroup, and Smith & Nephew. Today on the show, it's real estate with Andrew Moffs, Senior VP and Portfolio Manager at Vision Capital. Coming up, the deadline to file your taxes is on Thursday. We'll get some last-minute tips. The deadline to file your taxes is a Thursday. Let's get some last-minute tips from John Natale, Head of Tax, Retirement and Estate Planning Services in Wealth at Manulife Investment Management. John, thank you very much indeed for joining us.
Thanks for having me, Andy.
Give us one or two mistakes people make when they're filing, please.
Well, I think one of the biggest mistakes that people make is not having all their all their information, their tax slips, eligible expenses and so forth, and missing out on those. So you want to make sure you claim everything on your tax return to maximize your deductions and credits, but you also want to make sure you don't miss reporting any income, because obviously the tax man is going to come after you for that, and they have all those slips. The other thing that I think a lot of people, if you don't mind, the other thing I think that a lot of people don't realize, if you're in a lower tax bracket, and you may think, well, I'm not going to have to pay any taxes anyway, so what's the point of filing my tax return? Mm-hmm. There can be significant value to filing your tax return. And in fact, the government has introduced a program for low-income earners for the automatic tax filing, because you may be missing out on tax benefits, or government benefits, or tax credits. Or if you have a little bit of earned income, you may be generating a little bit of RSP contribution room that you can use in the future when it's most tax advantageous for you.
I think the government is mounting something of a push to get these people who feel, well, I'm outside the system, I don't need to file, to get them to file, because they are sometimes lower income people who are missing out.
Absolutely. I think that's probably the largest cohort of people who are missing out on filing their tax return. So the government, I do think it's a good initiative to try and help and encourage individuals to file their tax return, to make sure they're not missing out on these government benefits that the government has introduced for a specific reason. So if you're below a certain tax bracket, the government has introduced this program to allow for automatic filing.
Mm-hmm. Yeah. I wonder why we couldn't just do automatic filing across the board for Canadians. I know it might not work for entrepreneurs, but people who are in jobs, couldn't it just be automatic?
I would love that. And I think, if we compare Canada versus other countries around the globe, I think generally speaking, we're behind the curve a little bit on that. Our tax system is very complicated. There are lots of people complaining about the complexity and the amount of work required to file a tax return. It keeps a lot of us in the tax profession employed. So that's a good thing. But I think for the average Canadian, they would appreciate a little bit of simplicity when it came to filing their tax return.
Especially somebody who's in a regular job and they don't really have much in the way of special deductions.
100%. I couldn't agree more, Andy.
Remind us of a couple of deductions or credits that people are at risk of missing out on.
Well, if you don't file your tax return, you could miss out on the GST, HST credit. You could miss out on the child care benefit. So those are some things for the low-income earners. But other individuals, you want to pay attention to, for example, a lot of times people forget about child care expenses. That could include even summer camps, whatever, right? So you want to make sure you take care of that. Interest expenses, make sure you claim all your interest expenses. Investment and counseling fees. Moving expenses. If you move more than 40 kilometers closer to your job, you'd be able to claim some of those moving expenses. Now, you do want to be careful. Mm-hmm. If you get reimbursed by your employer for those moving expenses, that would be double dipping, and so you want to be careful about that. But those are just a couple common examples of potential deductions that people miss. Charitable receipts is another one as well, too. Make sure you claim your charitable receipts and have those receipts on hand in case you get audited.
Are there any notable tax rule changes we should watch out for here?
this year, the 2025 tax year was actually a pretty quiet year. And personally, I'm grateful for that. I think the biggest change that applies to almost everybody is the federal government reduced the lowest tax rate to, well, they actually reduced it to 14%, but it's going to only be 14.5% for 2025, and it's going to go down to 14% in 2026. So that is good news. It does reduce the tax you pay in the lowest tax bracket. But there is a counterpoint to that. It is a double-edged sword. It also reduces the amount of tax credit you get for some of your federal tax credit as well. So it is good news, but there is a counterpoint or a double-edged sword to it.
Remind us what they've done with this alternative minimum tax, which is the system designed to ensure that people pay at least some tax.
Yeah, so the alternative minimum tax is not an easy thing for people who are not in the tax field to understand. It's basically a second layer of tax. So we all file a regular tax return, and there's this other second set of rules to calculate your tax. It applies to individuals and certain trusts, and what the government is trying to do is if you've taken advantage of certain deductions, exemptions, or credits, and they feel you haven't paid your fair share of tax, they have this other set of rules. And they've changed those rules recently, and I think for the average Canadian, it's probably easier to avoid alternative minimum tax. For higher income earners, individuals, you may have greater exposure. And the big thing that just happened recently, Andy, Bill C-15 was passed just about a month ago, is they confirmed that for investment counseling fees, for AMT purposes, you only get a 50% deduction. And that's going to apply to 2024 and 2025 tax returns. So there are a lot of individuals who may have to go back and refile their 2024 return, or potentially even for 2025, if they haven't taken that into account, may have to look at refiling the return or file an adjustment to it or send in a letter. And remember that most trust tax returns are due 90 days after year end. So for 2025, many trust returns would have been due the end of March. So this is something that I think the tax community is definitely very aware of, but I think the average Canadian isn't.
The government a few years ago brought in this pretty generous benefit for first-time home buyers. Are you noticing a lot of people taking advantage of that?
Yeah, are you talking about the first home savings account?
Yes, that's the one. Yeah,
absolutely. That is to borrow someone else's quote. That's almost like the wonderful birth child of TFSAs and RSPs.
Right.
Because you make a contribution to your FHSA. Now you do have an $8,000 annual limit and a $40,000 cumulative limit. But you get a deduction for that. And then if you qualify as a first-time home buyer, you can withdraw it and not have to pay tax on the withdrawal. And unlike the home buyer's plan under the RSP rules, you don't have to pay it back. So it is a fantastic thing. I think anybody who's looking at buying a home in the future and they have the means to do so, it's an incredible tax-motivated saving strategy.
What if you build up money in it, though, and you end up not buying a house? What happens?
There are options that you can implement. You can actually transfer it over to your RSP on a tax-deferred basis.
That's pretty sweet. You get the deduction going in, like an RSP.
Right.
But you have a lot of flexibility when taking the money out.
You do. It is an amazing, I don't use this word too often. I almost fell off my chair when I first read about it, but it's an amazing tax planning technique or strategy.
John, thank you very much.
Andy, thank you. And I just want to congratulate you and wish you all the best in your retirement. And I did notice your April 30th date. I did find that interesting from a tax perspective.
Oh, yeah. My advisors in Switzerland said we'd do it like that. John, thank you very much.
Thank you for having me.
John Natale is head of tax, retirement and estate planning services in wealth at Manulife Investment and Management. On Hot Picks today, we are focusing on 3 growth and innovation stocks. And who better to walk us through that? Martin Toner, Director of Institutional Research, Growth and Innovation at ATB Capital Markets. Martin, always great to see you. Thanks for joining us. Before we get going, could we just touch on this story in the Wall Street Journal about OpenAI having slower growth than hoped? Do you attach it? I mean, we see these stories, obviously. AI slower than expected to pay off, for example.
Yeah, I mean, so they have made some big commitments, trillions of dollars of spend. The company's revenue growth has been doubling every 6 months. And at some point, the company gets absolutely massive if you double every 6 months, right? So, I mean, good growth stocks, basically the revenue growth slows at a slower pace than the market and investors are expecting. And yeah, I mean, this is hurting these stocks this morning, but I still think the demand for power from AI data centers is still a great theme that investors should take a look at.
Well, let's have a look at TeraWulf then. WULF. You see promise in this one. Remind us what they do, Martin, please.
Yeah, so TeraWulf is a company that is developing data centers for AI. Their biggest customer is FluidStack, which is part owned by Google, and TeraWulf themselves are about 10% owned by Google. So, you know, when I was last on, there was a lot of talk about a data center bubble. These stocks have all taken a really big break. TeraWulf included, I mean, kind of peaked around $15 back in November. And, you know, since then, deal terms for these companies has actually kept improving. The hyperscalers' CapEx plans have actually moved up. And very recently, there's been a lot of positive news in this space that have helped these stocks move up, TeraWulf included, as you can see by that chart.
And so are they actually, their roots are in power generation, I think. Are they actually building the data center? Sorry.
Yeah, so the company was born from the purchase of a large asset close to Niagara Falls that could take 750 megawatts of power. They first started Bitcoin mining on that site, and then when the AI data center demand came, they pivoted and they started leasing it out to customers who needed power and data center capacity for AI. So they are actually building buildings that will house racks for data centers, and then they lease those buildings to customers who roll in their racks and GPUs and start consuming power and doing AI. The company basically gets paid rental revenue per megawatt of power delivered. And the standard for these companies is about $1.5 million per megawatt. They have high margins, so they generate about $1 million in EBITDA per megawatt. And if TeraWulf is able to lease and deliver that entire facility, that'll be $700 million of EBITDA to the company. The company has an EV of about 15 billion, so that's a 20 times EBITDA multiple. Mature data center companies trade at about that range. The difference between them and Wolf is that Wolf is growing significantly faster, 3 to 4 times faster. And we believe the company has now become an operating company. They're able to develop new assets, lease them out, and grow revenues and EBITDA. And when you go from being an asset owner to an operating company, then you can start getting a multiple similar to mature data center companies like Digital Realty that trades, you know, in those 20-time ranges.
We're tight for time. Sorry about that. Keel Infrastructure used to be known as Bitfarms. What do they do? Why are you drawn to the stock?
Similar story, but a fast follower to names like TeraWulf. They've yet to find their first customer. They trade at around $1 million per megawatt of their portfolio. Wolf trades about 5 million, so 5x the value. Investors will be rewarded when this company signs its first customer. We expect that to happen late summer, sometime in the fall. They've got about 500 megawatts that they can lease out in the very near term. That would generate 500 million in EBITDA. That could generate 5 billion in value. Now they have to finance it. They'll need debt and they might need more equity. But the company right now has a 1.5 billion EV, so there's plenty of opportunity for the stock to move up on that catalyst.
And then finally, this is a very different company, Abax Technologies, and you just started coverage of this one, and it's an exchange on which people trade commodities, but it's physical commodities?
That's correct. So this is the first exchange to receive regulatory approval in about a decade. So they're bringing a clean sheet design technology stack to the problems of commodity markets. Their first, all of their contracts are physically settled. And their LNG and gold contracts are unique in that they are the only, in the case of LNG, physically settled contract that exists. And for the gold contract, it's the only physically settled contract in Asia. So the reason why that has benefit for participants is that without a physically settled future, they currently utilize things like Henry Hub. Those are not great hedges for LNG. That introduces risk, and in periods of market volatility, that can be extremely painful. And so that's what. So we believe ABAX's contracts will find a market. The stock is very, very expensive on a trailing or forward price to sales basis. But I mean, you should think of this stock like a biotech. It takes years and years to develop the product, get to revenue. But when approved and when the solution finds a market, the revenue can be significant. The margins should be extremely high, and these are natural monopoly businesses. In general, in exchanges, when a contract finds a market, there tends to be only one place to go, and as you can guess, like it's a natural for sort of the network effects of other companies like Google, and so those businesses tend to be rewarded with high multiples. And if ABAX is able to find these markets, there's tremendous potential for high multiples and a lot of value creation.
Martin, thank you very much indeed. You gave us 3 fresh ideas there. Martin Toner, Director of Institutional Research, Growth and Innovation at ATB Capital Markets. Coming up, apparently a billionaire tax proposal in California is seeing growing support. We'll have more after the break. One idea to address growing inequality south of the border, a new tax on billionaires. A proposal is advancing in California. ABC's Sophie Flay filed this report.
We have collected over 1.5 million signatures.
Supporters of a new tax on billionaires are celebrating, appearing to gain more than enough signatures to get the proposal on the November ballot in California. The measure would impose a one-time 5% tax on the assets of more than 200 billionaires living in the state, factoring in their stocks, art and collectibles, and their intellectual property. Labor unions say the money raised would address problems caused by recent cuts to healthcare programs.
Longer emergency room wait times, fewer healthcare workers, rural hospitals shutting down.
But Governor Gavin Newsom, along with Silicon Valley tech executives, fiercely opposed the proposal.
You would have a windfall one time, and then over the years, you would see a significant reduction in taxes because taxpayers will move. And that is what I fear at a state level.
Opponents saying the exodus has already begun to Florida, Texas, and Nevada.
When businesses leave California, thousands of good-paying jobs disappear.
Google's co-founder saying, "I fled socialism with my family in 1979 and know the devastating, oppressive society it created in the Soviet Union. I don't want California to end up in the same place." But others argue billionaires need to pay more of their fair share.
Invest a little more in keeping California running.
Sophie Flay, ABC News, New York.
Let's check in on the markets very quickly. Time running out for the open. There is the TSX under a little bit of pressure, but we have seen some prominent stocks like Great West, as I mentioned, and CIBC trading in record territory today. Let's have a look at Celestica, maybe intraday. The company beat in its latest quarter, but the forecast wasn't enough for investors who are looking for near exponential growth. And look at that, the stock is still up 4-fold in the past 12 months, but certainly Celestica giving up some ground today. The growth not matching the most optimistic projections. Let's check out Barrick. They're providing more details on this planned IPO of their North American and Dominican operations. It's not a great day for gold, so that stock is down in common with some other precious metal stocks today. It's going to be interesting, though, to see what kind of valuation the rest of Barrick gets. Will investors be wary, for example, of the country risk that comes with its African operations? A quick look at oil. Let's just see how it's been trading today. And oil, as you can see, up pretty sharply. Whoops, hitting the $100 there. Okay, rising oil prices linked to the Iran conflict are pushing up costs and disrupting supplies for personal protection equipment. CTV's John Venevali Rao had the latest in this report.
In a warehouse in Vaughan, Ontario,
all these have been really affected from the raw material shortage.
Daniel Pecchioli showed us the many boxes of disposable gloves his company gets manufactured in places like China.
Ronco, hand, head, and body protection solutions.
A family-run business, Ronco makes all sorts of personal protective gear, from lab coats and hair coverings to eyewear. And they're feeling the pinch from the conflict in Iran and global energy shock, because a lot of the raw materials that go into their items are a byproduct of oil and natural gas, which are in short supply in Asia.
It's impacting the cost of manufacture because the products that we use, which is a byproduct of oil, that cost has risen.
In particular, he says the cost to make disposable nitrile gloves used in hospitals for food prep or handling chemicals has gone up dramatically.
These type of gloves, they're going to be at an 80% increased price for the retail market in the next 2-3 months.
He says for some items, manufacturing costs are up 20 to 80% or more.
The latest I heard is some people have said up to 100%.
While Ronco has had to raise some prices, they say they haven't yet passed on the full cost to their customers. In Asia, which accounts for more than half of the world's manufacturing, the shortage in petrochemicals has made it harder to make plastics and synthetic materials like polyester, which go into thousands of consumer products.
The longer the conflict continues, the greater chance that we're going to start to see shortages and or inflation on some of these items.
Pecchioli expects these disposable gloves will soon be in short supply for retail.
It's going to happen May, June, and that's when there's going to be a shortage in the Canadian market for these.
Meanwhile, experts say even after the Strait of Hormuz reopens, it'll take months for the cost of some manufactured goods to stop their upward climb. John Venevali Rao, CTV News, Vaughan, Ontario.
That wraps up this edition of the Open Morning Markets with the one and only Roger Peterson coming up shortly. Roger's lurking here in the studio. Always great to see him. Thank you very much indeed for watching the Open. Handing you over to Roger.